Hello and welcome to Property Question Time. I'm Stephen Galpin and the show's coming to you today from our Canary Wharf studios. We'll be answering your questions and I have with me to answer those questions, first of all, Simon Taylor, who is co-founder of Empty Property Hunters Limited. Joining Simon is Greg Tarn, co-MD of Avamore Capital. Welcome to you. First time on the show.
Yeah, first time.
We'll try and be gentle with you. Simon, you're going first. There seems to be a lot of publicity around the implementation of penalties for keeping a property empty, particularly in London. What do the panel think about the morals here of perhaps a local authority imposing penalties on property owners who simply wish to keep their properties empty for whatever reason?
I think it's very much, it's nuanced and it's property dependent. So if it's, we're speaking to you from Canary Wharf and there's thousands of apartment blocks, large buildings, and if it's somebody that's maybe purchased some units overseas at a development roadshow and they own some apartments in Canary Wharf, and if they want to keep it empty, no problem, fill your boots, keep it empty, but there will be a penalty. I think there should be, because after all, there is a housing shortage, a housing crisis, and we want to encourage people gently, or not so gently, to put that property to use. It's surely only fair. But I understand an argument who might say, well, that's not fair, let me do what I want to do with it.
Yeah, you know, it might just be greener to not be using the electricity, not being able to use the water, not being able to have lots of rubbish to take away.
You're quite right, but of course we could say, well, what about the poor neighbour that's maybe next door or in the floor below where there's perhaps a leak? And it's coming from the property above where there's nobody there. I think there should be encouragement in some way, shape or form to use properties such as that. But you're really there, you're not being much trouble, you're not being a nuisance, but where I think the incentive or the need for clamping down on long-term empty properties, it's properties that are maybe mid-terrace, end-terrace, semi-detached houses where the garden's overgrown, the brickwork's knackered, the chimney stack is blowing in the wind. It could cause danger to neighbouring properties. It's a nuisance, it's an eyesore, and it becomes stressful and unfair really to the neighbours in the vicinity. So that's where I think the stick needs to be, or the whip needs to be cracked that little bit harder.
I get your points there, but I also just wonder about the enforcement of that. Are the local authorities going to be able to define between the different types of properties that they're going to penalise for being empty? How are they going to do that?
You're quite right, and it's perhaps it's going to have to be a blanket across the board, whether it's an apartment, whether it's a terrace, or whether it's a semi. So the current disincentive, should we say, are additional stamp duty taxes on people that purposely keep their property empty. So it's a doubling. Some local authorities will double it after a year or double after 2 years. Then eventually it will trip into a tripling of the stamp duty. And one owner that we spoke to only yesterday in the Midlands had purposely kept their property empty for 7 years, and they're quite rightly entitled to do so, but they've been paying triple council tax. And eventually the penny has dropped, should we say, and there comes a time where they've decided, you know what, it's enough. I can put this property should be put to better use. And, you know, I don't want to be, I could be spending that money on a holiday to Barbados rather than triple council tax.
Right, well, I think I agree with that sentiment. So have you got anything to add to that, Greg?
I mean, I think all those points are valid. I mean, I think you can make the argument that someone buys a property, you know, having paid tax as their property, can you really tell people what they should be doing with it? I think if it becomes a nuisance to the neighbours, as you said, either unsafe or an eyesore, which could then devalue the other property,
sure, and
make the road feel less residential, but then I think the argument's valid. But say in a block of flats, if a property's empty, I'm not sure how you can force someone to stay in their property.
No, and I'm certainly not saying it's you know it's something draconian where it's use it. If you don't use it, we're going to take it off your hands. It's just, should we say, some gentle nudging and encouragement to put your asset to work in a country where there's an acute housing shortage.
Yeah.
But even so, your sort of house scenario,
yes,
street of houses. I mean, I think the councils already have powers, don't they? Sort of antisocial behavioural powers to make you organise your garden or make you take away rubbish or...
you're totally right, and many local authorities will have an empty homes officer. Candidly, though, many of the tools, their apparatus at their disposal, there's limited they can really do.
Yeah.
And they might send you a letter, please could you tidy up your garden? The crazy thing is they're sending that to the...
I was going to say, there's no there.
There's nobody there, right? So I think, and there was a letter penned, which we put empty property hunters put their signature to back up to support. There is consensus across local authorities that something needs to be done, that stronger metrics need to be deployed. So it was a letter sent to the Secretary of Housing, where we're wanting to lobby the government to bring in more incentives for people to put their properties to use, and more measures and tools at the disposal of local authorities to help encourage. And it could be a case of, yes, extra stamp duty penalties, but it could also be some grants to help that owner of that property help get the garden ship-shape, get the property properly maintained. So it's not just stick, there's carrot there too.
Good. Well, on that optimistic note, we'll go to your first question, Greg. The requirement for large deposits by property lenders seems to be lessening. Is this a result of poor volume lending figures, or perhaps the result of stronger stress testing on borrowers? And I think that question can be asked in the light of the government's wish to have all these new homes built. Well, first of all, you've got to sell all these 1.5 million homes that are going to be built. No matter who the buyer is, they've got to be sold, and to be sold, they've got to be financed. So that's one part of it. But the other thing is, I'm not always convinced that the developers have got the access to the money to build all these homes, and whether the lenders are willing to make entrepreneurial decisions or speculative decisions in terms of lending. I mean, when I was involved in property development, the usual trick was that your lender would be saying, well, go abroad, go over to Hong Kong, Singapore, Kuala Lumpur, sell 20% of your stock, come back with the orders, and then we'll give you the money to build them. I mean, that used to be the sort of modus operandi. Then, of course, when you did that, they'd say, oh, well, yeah, but you've sold all these to overseas owners. They're not very strong covenants, really, are they? So can't you sell a few here? So you'd sell a few here, and they'd say, well, you've done that, but you've discounted them, so you're not hitting the numbers that you told us you would do. So it was a bit of a fight. But is it getting easier?
I think it's a great question. That really depends on the lender's appetite. So in the first charge lending space, lenders typically want to see sweat equity in a transaction from that developer. Of course, as you sort of go up the risk curve and you go into second charge or sort of more equity lending territory, views are taken on the equity, because ultimately you're getting more reward for your money. For me, it really comes down to, does one think that the money's going in from the developer is meaningful to them? And if that's a relatively small quantum, but one feels that they're all in, then a lot of lenders now, take the commercial view that they'll back that individual or that small company. If, as an example, one inherits a bit of money and one feels they're just pulling in to play with it and they don't really care about the outcome, then you'd want to see more money in to make sure that your position is further protected. But you're absolutely right. We're trying to build more houses. It's been a difficult couple of years for the property world, and you could argue developers especially. Liquidity for developers is poor, is weak. So lenders need to support our developers to get the houses built. I mean,
we've got a number of developments around here where developers have actually stopped digging the foundations, because to build perhaps a 70-story block these days, you're probably talking the thick end of £750 million. And with the volatility of material prices, that sort of thing, they're just dead starved. Because when you build that kind of project, you can't stop halfway and suddenly say, oh, well, I'll have a bit of a pause till the market comes right.
No. Well, that's why the last couple of years have been exceptionally challenging, because materials have gone up, so costs have increased, interest rates had been going up, so the viability of these projects for developers went down. Now we're in a a better environment where interest rates are coming down and have steadied, costs, prices, inflation has steadied. And when you look at a scheme now, the viability of that scheme, one would think would stay the same for the next 18 months, which is the sort of loans that...
I've mentioned this before on this programme. I just have this worry about material costs. You know, we're going to have to rebuild Gaza. We're going to have to do a huge amount of rebuilding in Ukraine and other areas of Eastern Europe, perhaps. That is going to cause a huge shortage of materials worldwide with the volume that's going to be needed. And I just wonder what that is going to do to the price of materials here. And, you know, our big contractors will be all out there trying to get these huge contracts, but will they be ignoring what's going on here?
I think that's a great point. I think the sort of the SME developers doing the smaller projects could well suffer in that regard. And that lenders now are more prudent, so contingencies are added to the build figures and buffers are taken. But you're absolutely right. If costs spiral again, then the schemes just aren't as viable, and keeping those developers then incentivized and motivated to finish the projects becomes challenging.
I just really don't think the government have thought through their whole process when it comes to estimating this 1.5 million homes to be built. I just, you know, I think my initial comment on that when I first saw it was good luck with that. But anyway, there we are. Well, that's all we've got time for in this half of the show. So join me again after the break when I'll be asking Simon and Greg more of your questions. Hello and welcome back to part 2 of Property Question Time. I'm Stephen Galpin and I'm joined by Greg Tarn and Simon Taylor. Welcome back, guys. Simon, UK repossessions of properties increased significantly in 2025. What do the panel think was the main cause of this, and is this a trend which will continue growing?
Well, I certainly believe it's going to continue growing. Moving into 2026 and 27, it's going well. It's multifaceted, isn't it? And I guess it's partly as a hangover from Liz Truss's, you know, the mini budget that we had, which pushed interest rates up, and many people going from rates that were maybe costing them a couple of £100 per month to service, and all of a sudden paying £600-700 per month, and that was putting a lot of strain and stress on many a homeowner. And then, of course, that homeowner perhaps needs to go to the supermarket and fill their shopping basket with bread and butter and chicken and meat, and the inflation that we've seen across that. So there's disposable income is constantly being eaten. And sometimes, I guess, if you've got young children, you're a family, maybe your job is less secure, maybe you're on a contract where hours are maybe being cut or less certain. Are you going to pay the mortgage? Are you going to put food in the fridge for your children? I know what I would choose. So it's no surprise that we're perhaps seeing missed payments and repossession numbers. Now, where I see things perhaps going is I think there's going to be I think that number is going to rise. I'm no economist, but from what I see, inflation ain't going anywhere. In fact, it's probably only going to get worse when you see the sharp rises in bond yields, and you see rampant inflation across precious metals, etc. There's something happening. And then if you add into the mix maybe AI and automation, how many jobs are going to be put at risk? So I think we're living in a horrible, uncertain world, and I think because of that, you're going to see an uptick in repossessions. I think it's, sadly, I think it's only inevitable.
I echo that sentiment. I agree. Something's got to give, as you say. If everything's becoming, you know, more and more expensive, then as you say, you're gonna put food on the table before paying your mortgage. But I think your point, Simon, around sort of AI and potential loss of jobs is clear. I
mean, I was reading some stats on London unemployment, and I mean, apparently it's doubled in the quite recent past. You know,
I'm sure we're all using a degree of maybe AI or automation or open source where it's helping us craft certain documents. You can only foresee that in 3 or 5 years' time that trickle is going to turn into an avalanche, and it's most quite unquestionably going to affect a number of jobs. So it's probably going to be an interesting time for mortgage products. I can't see interest rates coming down anytime soon. I don't know, and maybe I'm wrong. We'll see what happens. But I suppose the restructuring departments of big lenders are probably going to see a lot of people trying to restructure their mortgage lending and products. But I guess this is probably, the UK housing market has seen all this before. So no doubt there'll be clever innovations in mortgage products that will make allowances and delayed payments and holiday.
I was just going to say, do you think it's time for perhaps a review of the type of products that we offer? I'm thinking perhaps in terms of mortgages that stay with the property rather than the person, for instance, that can be handed down generation to generation and transferred. I mean, that could be an option, couldn't it?
It's a bugbear of mine. Greg might think differently. You look at the US mortgage market where somebody takes on a mortgage for 25, 30 years at X%, at 3%, and that is their percent for the duration of that loan. Whereas here, is it a racket? I don't know, where one is having to refinance every 2, 3, 4, 5 years, and the arrangement fees that involves, and the legal fees. And why can't we take a longer term view? I'd love to see a 10-year mortgage product, a 15-year mortgage product, and probably a consequence of people taking out short-term mortgages when rates were, 0.5% or less, taking out a 2-year deal. They're not perhaps sufficiently stress test, because the reality is, they can afford that cheap mortgage rate for 15, 20 years. But if they're only on a 2-year deal, they're going to be in deep trouble if things don't go their way.
But I suppose, especially when you're young and it's perhaps your first time purchase, 2 years seems a lifetime away, doesn't it?
Yes.
So
we've all been there.
But that's what happened. People got burnt. They were on their 2-year fixed mortgage.
Yeah.
The rates went up, and I can talk for sort of some of my peers, then they really struggled, because it makes sense.
Yeah, I mean, there were after COVID, particularly on that budget. I mean, there were huge increases in people's mortgage payments, weren't there?
Scary. You could say it's surprising that the economy may be looking as robust as it is, given the amount of disposable income that's been taken out of the economy.
Again, I think the general public have a bit of a misconception about inflation. It's come down 1%. Well, so what? It's still going up by 2-3% on top of last month's inflation figures. I think people don't really grasp that, do they? They're almost looking for reductions, but it ain't going to happen.
Totally. And the crazy thing is that the price of butter and milk and products such as that, that ultimately it has to have some sort of knock-on effect onto the housing market.
Food bills have shot up out of proportion, haven't they? I mean, every time you go to the supermarket or wherever, I mean, you just think to yourself, crikey, it just gets dearer every time I walk in this place.
Good for the diet, buy less.
I suppose it's good for the diet, yeah. So it saves you buying any weight loss needles or anything, doesn't it? But there we are. Okay, fine. Greg, mortgage lending interest rates seem nowadays to be less tied to exactly what the current base rate is, but the trend would seem to be a downward one. What do the experts think is the realistic prospect for rates over the next couple of years? And will this assist developers in looking for finance for their property developments to hit the government targets?
After the mini budget that Simon alluded to, that shocked the sort of development lending space, and for both lenders and developers. And as I said earlier, it made schemes unviable, and also hard for developers to assess projects, because they just didn't know where the interest rates were going to go. Now interest rates have certainly stabilised. You look at sort of the swap rates, it's sort of hovering around 3.5%. So developers now can sort of assess projects with more confidence, and whilst interest rates aren't directly linked to base rates in that development lending space, there's a clear correlation. So one can make a pretty accurate sort of steer of the finance cost of a project, which will certainly help in sort of getting developers moving again and going towards that government housing target. It's probably the most volatile sort of facet of a development project, really, is that interest rate. So
it can be crippling, because if you take, I think in London, the big blocks now, they're saying that the development cycle from conception to completion is probably 7 years. I mean, so if you've got to stand 7 years of volatility in the interest rate market, I mean, it's a dangerous game for everybody.
Very, very. I mean, in the sort of the more niche sort of specialist finance space, that the projects are slightly smaller. So you might be looking at 2.5 year projects. So a little bit less time to predict and assess. But absolutely, it's definitely a huge factor that everyone's putting that sort of interest margin buffer into to make sure things still stack up.
I know when I was involved in this sort of thing previously, you'd often be forced as a development entity to syndicate your borrowing, because the big banks, especially after 2008, would sort of say, you know, £500 million, much too much for us on our balance sheet. You're going to have to syndicate this. I mean, they just never appreciated the kind of problems that would cause when you have to go around half a dozen credit committees to sell your product, and they'd all be umming and ahhing about whether they were getting enough for it. But do you think those days are going to come back where people want to split the risk?
I think it makes sense. I think from developers it makes sense because they're not all with one institution. From lenders it makes sense because you're diversifying your risk. As you say, the getting through the different credit committees and the different credit appetite of different lenders, and everyone's got their niches, is probably the biggest roadblock. But you know, a lot of the developers now, especially sort of in the space, in the smaller sort of dev space, they rather go for ease and stick with one lender, you know, with the sort of stringent know your client, anti-money laundering.
Are we going back to more loyalty, perhaps?
Perhaps, but I think in so many of these development projects that there'll be different sort of joint venture partners. So the new individual in the venture will need to have their know your client checked, and some developers, which I understand, you know, they prefer not to have that hassle. So if they're with someone they know already, it just becomes easier.
Over this last 10 years, we've gone through a phase of specialist lenders developing. You know, we've got buy-to-let lenders, we've got sort of refurbishment lenders. Is that a good trend?
I think so, because then, you know, developers know where to go. So if you're looking at HMOs, housing multiple occupations, you can go to a certain lender. If you're in the student sector, you know, who specialises in that area. And I think the more a lender understands their niche and the nuances of the different products, the more seamless that the transaction should be. So I do think that's a positive step.
Okay.
Competition can only be a good thing within the development finance, refurbishment finance world. So the more choice, that's going to be better off for giving the developer a more competitive environment in which they're looking for their products. And I'm sure there's with finance, there's always clever ways. So there'll always be a new lender coming up with something clever where interest is rolled up to the end and there's a bit more forgiving. And I think it's probably in our industry and what you did, it's all about relationships, isn't it? I'm sure many the only advice would be, work with a lender that knows what they're doing. And is, well, I'm not, maybe compassionate is the wrong word, but there's special contingencies in your T's and C's that if things don't go according to plan, you're okay. And of course, personal guarantees is, well, that's another subject for another episode.
Okay. Well, on that very positive note, we'll end the show. So a big thank you to Greg Tarn of Avamore Capital. Thank you for coming in. I hope you've enjoyed your first show.
I have.
Thank you to Simon Taylor, co-founder of Empty Property Hunters Limited. Thank you for coming in.
Thank you.
Thank you for watching. I'm Stephen Galpin. See you next time on Property Question Time.